Is right now the right time to buy gold? I've been asked this question a bunch of times, and I've been sent this video talking about buying gold. And I wanted to go through it and talk a little bit about some of the information that he got incorrect and some of the reasonings behind how buying gold is not necessarily the right answer right now. It could be a fine answer, but I'll explain that a little bit more as I talk a little bit more about my investment strategy. Now, I'm Jeff Bullock, and I'm here to help people make smarter financial decisions with their money. So let's jump right into this and look at some of the things that he is saying.
Everywhere you look today, prices are rising quickly. Whether you're looking at assets or goods, real estate or stocks, crypto or gold, it looks like everything is a bubble. But
now, I wouldn't say that everything is in a bubble. A bubble is a little bit different than what he's explaining here. And I think that this is one of the things that he gets wrong a few times in his video, is that he is talking about a bubble when it's really should be talked about as inflation. Inflation is a really key aspect of where we are right now in society, because we have been dealing with higher than average inflation, higher inflation than the Federal Reserve would like. And that is where we are seeing a lot of the prices increasing throughout all of the industries, is we're having this higher than normal inflation. Now, the Federal Reserve, their responsibility is to keep that inflation below 4%. And so, of course, they've been increasing their interest rates to keep that down. And in the last year, the inflation has kind of stabilized, and therefore they are able to lower the interest rates and signal to the market that it is okay for them to invest more. Right, so they're okay with the inflation rate as it is, and that is why they are now lowering the interest rates. So it's not necessarily a bubble, but just that we're having higher than average inflation.
If everything is in a bubble, maybe nothing is.
Now that is exactly how it is, right? With inflation, there might be one or two things that are still in a bubble, but you have to now compare how quickly things are growing in comparison to how quickly other things are growing. Right, so if you take the percentage of growth, compare the percentage of growth, that's how you can really tell if something's in a bubble when it comes to inflationary time periods. Now, every time period has a little bit of inflation. Like I said, the Federal Reserve is shooting for about a 4% inflation rate. That 4% inflation rate, that means that every year we're going to be seeing some inflation, and that inflation is good. That helps people, so they invest. There's reason for them to invest for the future, things like that. So they do want to have some inflation. So you will see some of that inflation. Now, I'm going to jump ahead a little bit here, and we're going to talk a little bit about what he says next here. One of his other points is about how everything is in an all-time high. He says this multiple times. So let's just jump into here.
Russell 2000, which is small caps, is also trading near all-time highs, only being this high a couple of times in the last few years. And the United States Case-Shiller Home Price Index is also at all-time highs. So we have hard assets like gold and silver. We have crypto like Bitcoin. We have the stock market, whether you're looking at high growth tech stocks, mega caps, or small caps, everything touching all-time highs. Even real estate, whether you want to look at the US Case-Shiller Index, or even if you prefer looking simply at the median sale price of houses sold in the United States, which is...
All right, so he's talking about how everything is at this all-time high. And again, like I was saying, this is what inflation is. If everything was at an all-time low, we would be in a recession, or even if it lasted long enough, we would be in a depression. So most things should be at an all-time high. That is what the Federal Reserve wants to see. Say you go to the store and most of the groceries are now at a stagnant price, there's no change. That means that the grocery store owner is not making any additional money than they did last year. They wouldn't be able to make pay increases. They wouldn't be able to have growth. So there would be a stagnation and possibly a collapse in that grocery store. So you see that prices just normally increase. Housing prices increase. If they don't, why even buy? Why even invest in the housing market? And so you would see an all-time high in everything. That's not something to be worried about. That's not something to be concerned about. Everything is always going to be at an all-time high. That's just part of inflation over the years. The amount, the percentage increase in that all-time high is what we would want to look at. And over the last year, we've had higher than average, like I said, higher than 10% increase in those prices, and that's why the Federal Reserve is lowering them. But things will still be at an all-time high if they're even at a 2% increase. That's still an all-time high. All right, let's continue listening to what he says.
The question that you should always be asking yourself when you are trying to figure out if something is expensive is compared to what? And if Bitcoin and gold and silver and real estate and big stocks and tech stocks and industrial stocks and real estate and rent and beef and coffee and electricity and education and healthcare are all the most expensive they have ever been, then when you say compared to what, you can't compare them to each other because...
All right, so of course, like I was talking about again, you can compare the percent change that they've had, right? So for example, with gold, the percent change that gold has had over the past year has been significantly higher than the percent change that all of these other goods have had. The other goods have had high percent changes over the past year, but nothing quite as much as gold has. Of course, there's other things that have also had high increases, but that can be arguable that they are also in a bubble, right? So I would say that you can compare, you just have to compare percent change versus percent change.
They all look like they're in a bubble. The thing you're comparing them all to there is the dollar. Now you might be thinking, well, if you pull up a chart of the dollar, it really hasn't done much. In fact, it's at the exact same level it was back in 2015. It's had a little bit of volatility, but it's not falling through the floor like you might expect given the price of everything. The reason for this is because, again, you have to ask the question, compared to what? When you look at this chart of the dollar, you are comparing the dollar to other currencies around the world. That's what the DXY is, the dollar index. It's a dollar versus a basket of other fiat currencies, which means this chart looks pretty much exactly like what you should expect. Because if every government and central bank around the world is devaluing their own currency at around approximately the same rate, of course, you're not going to have that large of fluctuations in the value of one currency compared to another.
What you're seeing here is that most of the countries around the world are also having an inflation. They're having an inflationary period. And so when there's an inflationary period, there is a decrease in the value of the currencies. So that means that $1 can buy less goods than it used to buy. So as inflation goes up, prices increase, the value of the dollar decreases. And that is going to be similar around the world. That's because the US dollar is tied to almost every other economy around the world. So when the US dollar struggles, most other economies kind of feel that struggle as well. And so we in the United States have had an inflation, and other countries have had an inflationary period, and their currencies have also been weakening. And that's kind of what you're seeing here. All right, let's jump on to the next point that he makes here.
In America today, those who have the means to do so are buying assets to protect their money. And those who do not have the means to do so are dealing with the consequences of that inflation by buying goods, in other words, the cost of living, at the higher and higher prices.
Now, people are buying assets instead of keeping their money in cash. This is what would happen with any kind of inflation. We do have a normal 2 to 3% inflation, and even with that, it's better not to have cash just on your table sitting there. That cash on the table sitting there will continue to decrease in value as the inflation goes up. So you always want to have your money invested in some kind of asset, something that has appreciation over time. Now, with a higher inflationary period, that just incentivizes that even more. That's where the Federal Reserve comes in, where they're saying this is too high of inflation. If everybody continues to put all of their money into assets and stocks, this increases the inflation even more. And so they increase the interest rates, making it harder to invest your money into the stocks or take out loans to invest money into the stocks. So they're trying to slow that purchasing of assets so that the inflation stabilizes and slows down. That's what the Federal Reserve does so that they can get back down to that 4%. It's nothing crazy, nothing abnormal compared to what you would usually see in inflation. All right, now let's move on to his next point that he's making. Here, let's get this.
Other things as well. And for this, I would like to show you the price of things priced in gold for a couple of reasons. Number one, when you look back over hundreds or even thousands of years of human history, the purchasing power of 1 ounce of gold stays relatively stable throughout time. Whether you look at the salary of army captains, whether you look at the cost of a haircut, or the price of a custom 3-piece suit. When you price things in gold, it costs the same amount roughly throughout time. In other words, the amount of stuff you can buy with 1 ounce of gold stays about the same, regardless of where you look in history or when you look in history. It is a much more stable measuring stick in order to look at prices. And so when you see something at all-time highs priced in gold.
Now, gold in the past has been what economies have been based off of. It has been a stable commodity, and so economies have built their economy off of that so that they can have a stable economy as well. Now, the US dollar has been stable. It has become a more stable commodity, and so a lot of countries have based their currency, their economy off of the US dollar, and in more recent years, other economies have been looking for other things other than the US Treasury bond to base their economy off of, but it really hasn't made too much of a difference. Most economies still are based off of the US Treasury bond just because it is so stable. They aren't really based off of gold anymore. All right, so let's jump to the next part that he brings up.
In Bitcoin. Okay, so right here you are looking at a chart of the S&P 500, except instead of being priced in dollars, it's priced in gold. Now you may be looking at this and thinking, okay, going back to before the year 1900, the value of the S&P 500 compared to the value of gold is elevated, but you're certainly not going to look at this and think, oh my gosh, this is in a crazy bubble.
So we are seeing this dip here at the very end in all of these graphs that he's showing us. That is showing that the percentage increase in these other commodities or other indexes are dropping compared to the percentage increase of gold, meaning that gold is increasing at a higher rate than all of these other assets or indexes.
Valued. Definitely nowhere near bubble territory. Arguably not even expensive looking. This is a chart of the Russell 2000 priced in gold. Again, this only goes back to 1987, but this actually might look cheap. You can even look at charts from pricedingold.com to find prices of things like college tuition at Yale priced in gold. You can see not only is it nowhere near all-time highs, it's actually a lot closer to all-time lows. They have a chart.
So again, this is where the confusion comes in, is that when you want to purchase something, you want it to be comparably less expensive than other things that you could purchase. That is the ideal time to purchase things. This is showing the opposite. Gold is more expensive compared to other things that you can purchase. Therefore, gold, I would say, is in a bubble. Now, let's step back from this video. I think we've kind of talked a little bit about its points a little bit here. Just in conclusion with this video, he is explaining that right now is a good time to buy gold and that it's not in a bubble, that the whole economy is in a bubble and things like that. And to really conclude on this, I wouldn't say the economy in general is necessarily in a bubble. Is it in a higher inflation? Yes, higher inflation. It definitely is in. Does that mean that you can't compare gold to that? No, you can compare gold to that. Gold, I would say, is in a higher inflationary period, and we're seeing this gold rush. One of the biggest things that you can tell if something is in a bubble, I would say, is just if everyone is talking about it. If you go through YouTube videos and you see multiple YouTube videos about how you should buy gold, where you should buy gold. If your friend's talking about buying gold, if their neighbor's talking about buying gold, that is a big red flag for me. I would say that is definitely pointing out that there's a bubble there. If everybody and their dog is buying it, that's when you need to not buy it. That's when the price is too high. Now, at the same time, I would never buy something and just hope that you can pull out at the exact right time. That's never really a good strategy. The best strategy is to buy a good diversified portfolio with mutual funds that diversifies your portfolio really well. I would buy that diversification, and then I would hold it for 5 to 10 years. That means that no matter if there's a bubble, that means that no matter what's happening in that industry that you've purchased, in that product that you've purchased, whatever it is, most likely it will return to where you've purchased it or a higher value, and you'll get return on your investment. If you're trying to just time the market, you're never going to time it correctly. So it is best to ignore the timing of the market and hold it for 5 to 10 years. It's the same thing with gold. So when people are asking, should I buy gold? Is right now a good time to buy gold? I would say if you hold it for 5 to 10 years, do not try and buy gold and time the market. Especially behaviorally, when you buy gold now and it skyrockets, you are going to hold on to that gold and think that it will continue to skyrocket forever until it starts plummeting, and then you're going to freak out and sell the gold. But that timing, that freaking out, that behavior, it means that you usually do not time the market correctly. So the best thing is ignore these bubbles, these balloons, these influencers trying to explain when you should buy investments compared to other single investments. I would ignore all of that and just buy a well-diversified slew of different stocks, different investments. You can usually do that really well with buying several different mutual funds. And again, holding that for the longer period of time means that yes, you'll see ups, you'll see downs, you'll see bubbles, you'll see inflation, deflation, but it will over time have a higher inflation than you would if you just held on to one for a short time period. So it's that consistency, that longevity that you're looking for. Is it a good time to buy gold? It could be. Is it a good time to buy silver? It could be, if you hold on to it for a long time. Could you sell it at just the right time and make a fortune? You could. But is that the norm? No, the norm is that you'll most likely hold on to it too long, wait for it to drop, and sell it at a low. So the best thing, again, most people on average, and just what I would recommend, is just hold on to whatever assets you have 5 to 10 years. If you like this, please like and subscribe. Again, this is Jeff Bullock, just trying to help people make smarter choices with their money. And thank you.